Welcome to the latest episode of Beyond 60/40. I'm Sonali Basak. I am the Chief Investment Strategist at iCapital, and today I am joined by Torsten Slok. He is the Chief Economist at Apollo Global Management. Torsten, thank you for joining us. You have a view throughout the whole year that is interesting. You have some nuances relative to the rest of the market that is expecting interest rate cuts, but you do see this in a very nuanced way where we could be in an environment that we're higher for longer.
Yeah, because the story has changed quite dramatically from 2025. It was very clear in 2025 there were headwinds from the trade war. There were also headwinds from immigration restrictions. And the trade war itself, as Walmart has been saying, should have generated higher inflation and lower GDP growth or lower sales. So therefore, for most of last year, when you and I were talking about what was going on, it was all about what are the downside risks to the outlook. Coming into 2026, we now have a number of tailwinds. The most important tailwind is the One Big Beautiful Bill. That is going to change a lot of different things for consumers. You can now have childcare tax credits have gone up to $2,200. You also have immediate expensing for businesses that would like to do CapEx, and you can write it down immediately this year instead of over 5 years. All those things are going to be busy in terms of creating activity for CapEx and also for hiring for the next several quarters. On top of that, we also have oil prices are lower. We also have the dollar is lower. And we still have an AI and data center boom in the background. And finally, we also have the World Cup soccer this summer. All these things are absolutely helping for pushing growth higher over the next several quarters. So the narrative has changed from we're worried about the downside risk, so now we're actually beginning to worry about the upside risk to the outlook.
It's interesting because you saw the market, parts of the market react pretty strongly to the prospect of interest rate cuts. Is this simply translating to growth will be higher than people are really accounting for, and therefore we don't need to cut interest rates as much as investors initially felt?
Yeah, because the main problem is that when we entered 2026, inflation was still around 3. The Federal Reserve has the goal that inflation should be 2. And given that 2 is not 3, this was the reason why recently Jay Powell recorded a video on a Sunday evening saying, we have to do what Congress has mandated the Fed to do, namely get inflation down to 2%. And given the still a 3, that means that if we are 3 and now there's a risk that the economy may begin to get better as we go through this year, that raises the risk that inflation is going to be more sticky. And that is the reason why the Fed themselves only expect one cut in 2026. So the key conclusion for investors is interest rates in the front end of the yield curve are going to stay higher for longer because inflation is going to stay higher for longer.
What do you feel about inflation moving forward? Do you think that it will remain sticky, or is there room for moderation actually here?
There are some components of inflation, namely housing, which is pulling downwards. That's a weight of roughly a third in the CPI index. But there's other components of the CPI that are pushing higher, namely, most importantly, there's still some delayed effects of tariffs that are putting upward pressure on goods inflation. The dollar going down means that it's more expensive to buy things abroad. That's also putting upward pressure on inflation. And in the services sector, we're also beginning to see more signs of upward pressure on inflation coming from the services PMI. So the conclusion is some components are indeed dragging things down, but other components are actually pushing up. So exactly as you're saying, Sonali, I expect inflation to be more sticky at around 3%. And that's also why the Fed is going into this year in much more cautious mode and saying we are no longer cutting rates before we are 100% sure that inflation is again beginning to go down. And that's what is the discussion, namely will stock market continue to be trading the way it is, or is there a risk that if rates are higher for longer because inflation is higher for longer, that the stock market will also begin to pay attention to the fact that inflation still continues to be a problem?
Well, what is the chance that we actually, when you look at 2027, actually start to see a rate hike?
Yeah, so of course, if we get an overheating economy this year because of the One Big Beautiful Bill, we still have an AI boom, we still have lower oil prices and also a lower dollar, then the risks are indeed beginning to rise that we could have a hike in 2027. That's not our baseline, but from a market perspective, it's very clear that this expectation that interest rates are going to go down, it has to be viewed in light of what is inflation, because the biggest fear among investors should be that we bring back some of the risk from 2022 when the 60/40 portfolio did very poorly because interest rates had to go up and the stock market went down.
That's a big statement.
Yeah, but that's why the 60/40 portfolio is unlikely to do well this year, because when inflation is higher for longer, there's a memory very recently of 2022 where this is going to potentially create some problems, especially if we at the same time have AI not delivering on the very significant promises that are at the moment priced into markets.
Yeah, we'll talk a little more about that, because that 60/40 issue is certainly why we see investors looking for diversification in private markets, but we'll get there. First, I want to talk about the macro a little more, because I'm like you, I'm relatively bullish about growth, but you're looking at growth happening recently, perhaps perhaps at the expense of the labor market in a lot of ways. How long does that continue on for?
Yeah, so a very important issue is that the labor market has shown weaker data, meaning employment growth has been slowing. But a very critical reason for that is that immigration has been declining very significantly. In the years 2022, 23, and 24, net immigration into the US was about 3 million people. So of course, when you have 3 million people coming into the country, that's more people looking for jobs, that's more people buying a house, that's more people shopping at Walmart, more people paying taxes. Now the Congressional Budget Office is saying that net immigration is going to decline from those 3 million to around 500,000. So as a result of that, the Federal Reserve has calculated that non-farm payrolls used to be 200,000 in those years. Now they are saying it's about 30,000. So the break-even rate for what is a good number for employment growth has dropped very significantly because of immigration declining so significantly. So if we now have a job growth of, say, 50, 60, 70,000 jobs, that's actually not bad because all those numbers are higher than the 30,000 that the Fed has set, which is the new break-even rate. So in short, the labor market weakening is making the economy more fragile. And I completely agree with what you're saying, that this does raise the risk that if you bump closer to zero, that there is a chance that you could have some hit that could create negative job growth, which of course would get a lot of attention in financial markets. But so far, if it's more like a Nike swoosh where growth was slowing down last year, I do expect that we're at the bottom of the Nike swoosh and things are about to get better over this coming quarters because of the One Big Beautiful Bill and the AI boom still continuing.
So when you think about the job market in particular, do you think that 50, 60,000 non-farm payrolls growth, is that the new normal?
Yeah, that is the new normal. And that's what we all have to get so used to, because for all these years, when you and I have been talking about what's going on in employment, it has to be 150, 200,000. Now we suddenly have to get used to, well, because there's just fewer people coming into the country, and slightly also because the baby boomers are retiring. But all those things combined basically mean that we have to get used to that job growth is basically going to be a lot lower. And that, of course, increases the risk that if job growth suddenly begins to trickle closer down to zero, then, of course, a lot of people begin to worry about, wow, that means that the economy is slowing. But a different way of saying this is the reason why job growth has slowed has less to do with labor demand and has much more to do with labor supply. So for that reason, the labor market continues to be critical. The Federal Reserve repeatedly says this. The labor market is slowing, and they are watching very carefully. Is this because of slower labor demand, meaning companies doing worse, or is it simply just because there are fewer immigrants coming into the country?
You know, last year, you remember there was so much rhetoric around how artificial intelligence could impact the job market. Reality is, the data recently, a lot of the changes you're seeing in the job market are, as you said, immigration. We've heard also a lot of companies waiting to hire because of tariff uncertainty, that being another issue, maybe reallocating some resources across business lines, M&A also. How much is AI really making a dent in the job market today?
So at this point, when Jay Powell was asked that at the last press conference, he basically said he is not seeing any impact at this point. But it is very clear that the youth unemployment rate has begun to go up, and there's a lot of conversations around young people having a hard time finding a job. Are they being replaced by AI, or is it just that the business cycle is a little bit weaker, or what are the reasons why youth unemployment has gone up? That is, of course, worrying at many levels. But if you look at the AI adoption rate, both from the RAMP survey and also from the census survey, there are some signs that AI adoption is beginning to flatten out. And in particular, if you look at the S&P 500, a lot of the earnings expectations for 2026 have mainly been in the Magnificent Seven, but earnings expectations to the S&P 493 have actually not gone up in the last year. So that's telling us very importantly that for AI to continue to roll full steam ahead in 2026, we need to begin to see over the coming months some signs of AI showing up in higher earnings expectations to the S&P 493. So that is not only a tech story, but it's also a story that shows up outside of the tech sector. And that's what becomes critical also for the labor market and for the AI story more generally, namely, what are the pieces of evidence that this is actually showing up in the economy? And so far, there's a lot of adoption. We are all installing all kinds of programs, and it is absolutely making a big difference and will make a big difference in our lives. But at this point, we have just not quite seen in the macro data any change in employment, in productivity, and therefore we got to watch this year whether it's actually especially spilling over to the what broadly speaking can be described as the S&P 493 for that benefit to begin to be a broader benefit for the economy.
It's funny that you mention it that way in particular. Something I've been thinking about a lot when it comes to AI is this going to be such a game-changing technology that it'll overhaul the systems that we know today? Or is it going to be something like when you go to Google something, you'll just see the Google AI products embedded. When you go to use Meta or Instagram, you'll see AI within the existing products. Will it be a little more subtle than people realize?
Well, and that's exactly why for the broader economy, If AI fails, then it's very clear that we have some equity valuations, especially for the Magnificent Seven, that are very expensive. So in that sense, if AI does not deliver on all the promises this year, and if companies in AI do not deliver earnings on the promises that are priced in at the moment, then that will be a problem. But ironically, if AI widely succeeds and therefore the unemployment rate begins to go up because everyone becomes much more productive, that will also be a problem, because then you will have disruption in a number of different sectors. There's a lot of conversation about software. There's also media. There's a lot of areas where you begin to ask the question, well, if AI really succeeds, you could have disruption in a very substantial way. So equity investors really need to stay on the edge of their seat going into this year, because the key issue becomes, if it fails, you need to be alert. And if it is widely successful, you also need to then get out of those sectors that are getting disrupted. So in that sense, the path for this to be just steady, stable where we are at the moment is fairly narrow, because there are some high probabilities that we could either see something that's widely successful and push the unemployment rate up, or we could see something where, well, if this doesn't change much and it's just embedded in your Google search, well, then the consequence is that then a lot of these valuations just look very high at the moment.
And I should say it's interesting. Apollo has had such an interesting AI strategy and exposure to some really big names in the space like Intel and XAI. But let's ask this from a very big macro perspective, knowing how you look at the world. Is AI ultimately going to be something that creates productivity at the expense of the job market long term?
So this is a very important discussion, namely, is it labor enhancing or is it labor replacing? So far, we just don't have an answer to this. It's just too early. Also, if you think about it, AI at the moment really is large language models. And if you take your phone out and my phone out, and we do have a model, of course, from Gemini, ChatGPT, Perplexity, Claude, Grok, it is actually still at this point a little bit difficult as a user to figure out what is the difference between these different models. Maybe Claude is known for being better at coding, but this is actually quite different from a corporate finance perspective. If we invent a new product as a business, you normally have a period where you have the market for yourself. And at the moment, so many new products have been invented, but there are none of these who really have the market for themselves, which raises the risk, of course, that the price that people are willing to pay for these different large language models is at risk of being under downward pressure. So you're absolutely right. It becomes very important this year to begin to see other ways that AI is being deployed for ultimately, from a macro perspective, to begin to see this. So to your question, is it labor enhancing or labor replacing? At the moment, a lot of people are getting hired in AI. So in the early stages, you should actually expect employment to go up, especially, of course, for tech and computer programmers that are using AI. Of course, other computer programmers are eventually likely to begin to see their employment go down. But broadly speaking, at this point, we've only seen, from an employment perspective, mainly the positive effects.
So I'm going to ask you about AI as it pertains to inflation. At what point does it become a more deflationary force?
Yeah, and that's also very important, because so far the forecast for inflation from the Fed, from the consensus, from us, is that it's going to be sticky. You could view that as we are all throwing in the towel in your question and saying, we don't know if it really is very successful, then of course inflation will be going down. Also, if the scenario that AI is going to be very, very successful, then we will also have that the debt problem for the US government will also look very different, because suddenly we will have significant income gains and therefore we'll have significant tax payments. And if that's the case, then we can pay down our debt a lot faster. So there's a lot of different dimensions. The risk is indeed that AI, if it is very, very successful, and here risk meant in a positive way, that inflation could actually be a lot lower, and also that the debt problem that we all worry so much about could actually be a lot smaller. So there's a lot of things that will come out of a situation where AI is going to be a big boost and a wild success in the economy.
I want to talk to you about that debt problem. I'm glad you brought it up, because we started this conversation on the higher for longer dynamic. If short-term rates stay higher for longer, that would naturally mean interest expenses would also be higher for longer. It would also mean that the government is also absorbing a few things. Increased fiscal pressures here, especially as the Trump administration steps up to try to close that hole in the K-shaped economy. That's fiscal spend. There's increased defense spend. And so there's a few reasons here that would suggest longer-term interest rates remaining higher. How underappreciated are those risks in the market?
Well, I think that those are very underappreciated risks, because in the front end, short-term interest rates will be higher for longer because inflation is higher for longer. In the long end, the fiscal challenges just continue to grow. If we think about the long end of the yield curve, say 30-year government bonds, who has historically been the buyer of 30-year government bonds? That has historically been pension and insurance, because pension and insurance have 30-year liabilities. They need some 30-year assets. So they take the cash flow from that 30-year asset to pay the 30-year liabilities. If I'm an insurance company, I owe some people payments on their annuities. If I'm a pension fund, I owe the members of my pension fund a cash flow payment that they have been expecting for the rest of their life. So if you do have that there now suddenly is assets and liabilities in the long run that need to be matched. What is the environment today? What is it pension insurance is buying today? It's not so much 30-year treasuries. It's much more privately issued long-duration assets, including privately issued long-duration assets from Apollo. Those would be assets such as data center debt, it is climate long-duration assets, it's infrastructure long-duration assets, it's energy transition long-duration assets. And these assets, in many cases, have actually a better risk-return profile with higher returns, and in many cases, investment-grade credit that basically is actually, for many of pension insurance companies, a better match with their liabilities. So that's why the challenge in the long end of the yield curve is that there is more competition in long-duration assets instead of just only having 30-year treasuries. And that means that issuance of treasuries, also under Janet Yellen, now under Scott Bessent, is beginning to move to the left, meaning that there's more issuance in the front end of the yield curve, including also in T-bills for stablecoin reasons, and all that is beginning to point in the direction that the average maturity of debt outstanding will begin to decline for US government debt because more and more focus is in the front end of the yield curve. So that's why if there's less demand in the long end, the main conclusion is short rates will be higher for longer because inflation is higher for longer, and long rates will be higher for longer simply because we have too much debt that will continue to be a problem for longer.
You know, when you think about the Treasury market, how concerned are you about market structure? You've written a lot about how stablecoins will be a bigger part of what absorbs all of that issuance.
Yeah.
Is that safe? Is it healthy?
So a very important part of that, of course, is that as issuance goes to the left and there's more issues in T-bills and more issues in 2, 3, and 5-year rates, the consequence, of course, of that is that, well, someone needs to buy all this front-end rates and front-end issuance. And it's particular in T-bills. The main buyer of T-bills has historically, of course, been money market funds. But a new buyer is emerging with stablecoins. And stablecoin issuance, of course, is the idea that people around the world can on their phone now use stablecoins to buy a cup of coffee in cities around the world. They can even buy maybe a car, and maybe they can even buy a house with stablecoins, especially, of course, in emerging markets that have more unstable financial systems. So the question for 2026 for this is indeed, is there going to be a dramatic increase in demand? There are some people forecasting that we'll have stablecoin demand at roughly 2 trillion by the next several years. So the conclusion is, if that happens, we will have a lot more demand for T-bills, because remember, stablecoins are backed by T-bills. But if we do not have that, then of course all the T-bills need to find another buyer. And that's, of course, recently the Federal Reserve began to buy 40 billion in T-bills every month. But that's, of course, why this issue around who ultimately is the buyer of US government debt continues to be so critical. And can we find that new buyer in the front end, or can we not? And if not, it will begin to cause some challenges and worries about financial stability and the risks that come associated with that. But the big picture is, we are having too much debt. The deficit is 6% of GDP. Someone needs to buy that. And the challenge for the Treasury when they issue government debt is to think about where on the yield curve should we issue to get that demand fulfilled.
It's interesting. You know, when I talk to clients, I kind of point it out as a few kinds of risk. There's credit risk, there's liquidity risk, and there's duration risk. All of a sudden, you have so many clients saying, well, liquidity risk doesn't look so bad. Actually, duration risk worries me more in the Treasury market. Do you find that dynamic happening?
I totally agree. And I look at it the exact same way, namely that those are the different ways of putting into a framework for thinking about what types of risks is it that we're looking at. And the duration risk is indeed beginning to show up more and more. If you take a chart and look at 24 months Fed fund futures, which tells you something about what is the market expecting the Fed will do over the next 2 years. If you take that chart and overlay that with 10-year interest rates, it has for many, many years been completely on top of each other. Long-term interest rates were driven by Fed expectations. But about a year ago, there was suddenly a disconnect where you no longer have that 10-year interest rates are driven only by Fed expectations. Now there's something else going on. And the worry is that markets are beginning to price in a higher term premium, a higher risk that maybe the fiscal situation is a bit more worrying. And for that reason, 10-year interest rates today are actually higher than where they should be. And that, of course, begins to raise questions around, well, why is it that people are not willing to buy 10 and 30-year government debt? And if it is the fiscal situation, then, of course, this is something that markets then need to think about. Also in 2026, what are then the premiums that should be required to buy long duration in the US relative to where Fed expectations are?
Okay, before I let you go, let's think about 2026 broadly. And you have a list of things that you're looking at this year. And it's everything from the World Cup, like we've been saying, to what's happening in Europe. If you had to pick one, you have to pick a favorite child here. What is the one thing that you think will be the defining issue of this year?
Well, If I can allow to just say two, I think the thing we have talked about is inflation is number one. But I think that the second one is absolutely what will happen to AI. If AI is going to roll over, then a lot of valuations are beginning to become problematic. Because getting back to the title of our show here, that is 60-40 portfolio. The 60-40 portfolio, if you really begin to think about the 60-40 portfolio, what is in my 60? What is in my 40? We generally tend to say 60, oh, that's just stocks, and 40, oh, that's just US government bonds. But now the 40 is also public credit. Maybe even some of this is fixed income replacement, which is private credit. Maybe even on the equity side, well, if it's all AI, maybe the 60 is so exposed to just one factor or one component, namely AI, that maybe even inside the 60, I should begin to say I have too much exposure to AI. I need to have exposure to something else. So that's, of course, why private markets fit very well, both into the 60s as equity replacement, but also into the 40 as fixed income replacement, trying to look for other areas, especially if I have too much exposure to AI. And the final point in this from a 60-40 portfolio perspective is that I also have AI exposure not only in the equity part, because the 10 biggest stocks make up 40% of the S&P 500, but now also in the public IG index is also changing. It used to be that was mainly banks, but now the hyperscalers are issuing a lot of debt, so that's also changing into be more AI sensitive. And finally, even the venture capital part of my portfolio, that's also 2/3 of venture capital that's now being deployed is also AI. So there's basically AI everywhere in my portfolio. There's AI also in CapEx spending. There's also AI in consumer spending. So if AI does not deliver, in the worst case, if it really begins to disappoint, then it will be not only for GDP and consumer spending and CapEx spending, but it would actually also be portfolios. And there are just not many places in portfolios where AI is not present. And that's exactly where private markets and other international markets or gold or other things become more important, because suddenly maybe there is a good argument this year for beginning to diversify away so that you're not just only exposed to AI in your portfolio.
Yeah, the classic, don't keep all your eggs in one basket.
That's page 1 in your finance textbook, and that's still a good idea.
Torsten, we thank you so much for joining us here. Of course, that is Torsten Slok. He is the chief economist at Apollo on our latest episode of Beyond 6040.